Hi, students. Today we're going to talk about exchange rate, and it's a big topic, very big topic. So I highly recommend that you watch this video multiple times. Let me go first to the calendar and to show where we are standing as of today. So we are Thanksgiving break here, and next week, which is this today's Saturday. So next week will be exchange rate and stock market performance, and the assignment will be in Canvas. So we're going to work on that. Now here's the outline of today's class. It's very, very hard, the class today, really hard. So what I really hope that you start working in this week assignment early, not to wait till Tuesday. So we're going to talk about exchange rate sensitivity, main currencies, swap, and crypto solution. So we'll probably say, Yosef, what is that? What are you talking about? Well, I'm going to give you an example here, but this is the outline. If you think about Apple, for example, if you go to Apple, Apple, headquarters of Apple in California, and they have a tech support in Austin, Texas. So you would think Apple is an American company. No, Apple, the headquarters is in America, but it's not American company. Apple is Apple is international company or global company. And in fact, the revenue for Apple mostly come from outside the United States, because America is a 360 million. Let's assume half of them use Apple, or 2/3 use Apple. So maybe 250 million cell phone, but the world 7 billion. So most of their stocks are, most of their sales are abroad. So the exchange rate matters for Apple, and I will explain every piece of it. But let me show you something here. 5 years, Apple's performed in the past 5 years. Cancel. When I analyze a company, international company, or first I want to see the eye test to see what the company is doing. So in the 5 years, did 156%. If I compare them with the S&P, not sure what is that number, but 2 years, you can see the S&P did 50% in 2 years. Apple 134. Apple 134. Now, my main comparison, usually I compare with the Nasdaq, because Apple is a tech company. So I'm going to take the S&P and see the Nasdaq. Yes, the Apple beat the Nasdaq, which is good. Now, what I want to show you here in Apple to understand how much important our class is in 2018. In 2018, and let me make it bigger here so we can zoom in 2018 more. Good. Now we zoom. Apple reached the share of Apple. By the way, it's 55 because they have a split. The share was in the hundreds. They split it, become to be 55. Like if a stock is $100 a share, if you split it to 2, so the share become to be 50. In the second they split, but then the price start going up again. So in 2018, August, Apple reached almost all-time high at 56.91. And then what happened is Donald Trump was going to Twitter, attacking China. And every time he goes to Twitter, Apple going down. I mean, I was watching Twitter, so go short Apple. When no Twitters, we go by Apple. Just as simple as that. When Trump, you have to put Trump Twitter and Apple. It was fun. It really was fun time to make money. Because when he tweets, Apple has to go down. Why? Because it's an international company. So when Trump was attacking China, the price of Apple went down to 37. It's a lot of down here. A lot of down. About $20 maybe. It's a lot of money for $56 a share. So international trade matters. And then another problem was only Trump was doing tariffs in China and things, and that hurt Apple. But also China was manipulating their currency, because when Trump put tariffs, China lowered their currency. So when you lower your currency, the iPhone become to be expensive for the Chinese, and people buy less Apple iPhone. But Apple solved this problem by something called swap. So I will talk about the swap. So the solution was a swap, to make a lot of swap, to help Apple to manage the currency manipulation and Trump tweet. We didn't want we didn't want the US president to tweet. We didn't want trade war between countries. We want a negotiation. We have a State Department. They have a salaries. They have a budget. So the idea is the State Department go and negotiate deals with the agriculture company if there's agriculture department. We didn't want war. But when you have a war, you have to go and use your financial tools. And Apple was one of the best companies doing swap. Their lengthy arm. Small companies got smashed. But Apple, they were capabilities to build swap. So international trade is important. As I said, Apple has most of their revenue is outside the US. But you say, okay, Yosef, they sell the smartphone in China, then they immediately go to the bank and get the in dollars and back to America. No, it's not simple as that, because Apple has suppliers in Malaysia. Apple has suppliers in China. Apple has hired workers in China. They have a couple 100,000 workers around the world. They have to pay their salaries. So they have to pay it in their currency. So in China, Apple has to pay in Chinese yen currency. In Malaysia, Malaysian. In South Korea, in the won currency. In Japan, yen currency. So Apple is a big basket of currencies they have, because the cell phone is in different countries. Every country have different currency, and then they have to do a lot of swap. So your sales in different currency and your workers in different currencies. They hire people, they have a stores, they have to hire people with different currency. The solution is a crypto, obviously. Everybody knows that in the world. But the problem, politicians don't want to make a crypto. A crypto is a solution. Why? Because if everybody uses Ethereum or Bitcoin, whatever you want to do, any crypto, if everybody uses it, then we didn't need swap. By the way, the swap is $1 trillion. Trillion with a T, trillions. This business swap. So then we're done. We didn't have a swap. We're done. And there is no currency manipulation, and there is no exchange rate sensitivity. There's no exchange rate. And that's it. We're done. We're done. So the only tool for the government to protect import and export is tariffs. You put tariff in another country. That's the only thing. But you cannot manipulate currency because everybody uses crypto. That's a solution. I'll talk about it. So let's start about, again, I explained to you the motivation. Most of the US company, 40% of the S&P companies, their earnings are overseas. Almost 50. We're going down to 50. That means 50% of the American business is outside of America. That's amazing. That's never happened before like that. Usually everything is here. In the early 80s, start to have, before the 80s was most of the US economies in America, less trade. After the 80s, become to be very dependent in the world, which is good. It's good to have a world independence, because everybody will have a small size to maneuver, which is good. I mean, the best in the world, if we have a crypto, everybody is the same currency. Forget a crypto, euro. Use European currency. I don't care, any currency. Canadian dollar, I'm fine with it. American dollar, any currency. But one currency, all world. Then you save a lot of money, fees and this. That's good. So exchange rate. So what's the deal here? You will have these slides here. What's exchange rate? Exchange rate, if you go to Investopedia, you can see everything you need here. That's about swap. Exchange rate in Investopedia. So an exchange rate is a value for the currency. And here there's example with the British have a pound. I forgot that. So that's a definition. So exchange rate, it's this. An exchange rate is the value of one nation's currency versus the currency of another nation. So if you want, I can give you the link here. Copy. Hyperlink. So here the copy of that. Now exchange rate sensitivity, see a Word document in the files. So this will be in the files. You will find a Word document that I'm going to jump on it now. And that's exchange rate. So we're going to work on this slide. Once I finish that, we're going to have another exercise with the swap. I have an exercise for you for swap. It's right here. And also I will save it and you can see it there. Exchange rate sensitivity, we're going to start with it now. So what is that exchange rate sensitivity? Stop sharing. All right, so now every company have a business outside the United States. So suppose they have in China business. So in China, you hire workers and you pay them salaries, but you sell in China, so you have a revenue from the Chinese currency. So you have a revenue and cost of revenue. So this in different currency, and you are American. Now suppose one Chinese yen equal $1 American, then that's fine. If it stays 1-to-1, we're done. But what if the Chinese currency went down 10%? Then you lost 10% immediately. You have the same sale, the same people, but because the currency went down, then you lose a lot of business. So therefore, we need to examine how much your profitability as a company is sensitive to the exchange rate of a company. So we're going to go share screen. We're going to go to a Word document called exchange rate sensitivity. So exchange rate sensitivity, this is a Word document. You're going to see it there. Let's make it font 14. And it says, any company, the main model, company return, RGT return minus RF. RF is risk-free return. The reason we have the risk-free return in our model is to protect inflation, because if some country, like the US, if the company did 30% return and the inflation was 50%, basically you're not doing good. So we have to protect inflation. So the bond rate is reflect the inflation. Equal a constant alpha J plus theta J multiplied by the exchange rate of the company, of the country of interest. And mu T is the unobservable error. If you want to extend the model, which is a company return equal this, RTG, which is here, the definition, by the way, is a company return minus RF, risk-free return accounts for inflation, and then you have equals a constant plus beta J, which is beta reflect company J risk, multiplied by RM minus RF. RM is a market return, in this case could be the S&P. RF is risk-free, which means access return. RM minus RF, we call it risk premium or market access return, market access return. Okay, and then plus theta J. Theta J is a sensitivity. Usually I use theta for sensitivity because Robert Lucas and Tom Sargent, who got Nobel Prize, both of them, they use always theta. So become to be in our business, theta is the parameter for sensitivity. And then exchange rate, like US dollar exchange rate to foreign currency. The main currency in the world is now euro and European yuan. When I'm sorry, I have accent. Probably the Chinese students will laugh at me, or I hope I'm not hurting their feelings. I think they call it yuan in America. And then there is Japanese yen. Maybe I'm saying that not properly. My apologies if I have a Japanese students. And then the C dollar, which is Canadian dollar. And the won, I think this is for South Korea at time T. So there is a basket of currencies. We're going to analyze Apple today. We're going to focus on the yuan because Apple has big sales in China, and then Europe, and then Japan and Canada and other countries. So we need to collect data about all of these variables that we have. RTG minus RF, alpha J, so which is, we need the company return, risk-free, market return minus risk-free, and the exchange rate. So we have a 1, 2, 3, 4 variables. We need to collect the data. So we're going to start one by one. We're going to go FAMA library. When you replicate the work, you didn't need to do this, get the data. I'm going to put that in Excel so you can use it. So we can use the 3 factors. Okay, so you have a date here. We didn't need the first 2 here. I didn't need the other, these 2 columns. We use them in academic research, but for the class purpose, we didn't need that. We didn't need to go all the way to 1926. We're gonna go from 2000 and on. So I'm thinking to have a 10 years or 20 years. All right, 20 years is better, I guess. Let's go 15 years, like from 2005, because a lot of the world is changing a lot. Really, the world changed a lot over time. So delete, we get that. Now, some of you, when you do regression, didn't know that there are also annual rates here. So I didn't need that. So I delete them. Okay, there's something here I see. All right, I delete that. So we're using the data from 2005, January. Now I need a company J return, and I need exchange rate. I'm going to use Apple because we have the 2018 I mentioned about tweet about Trump. So it's very sensitive to Chinese. We want to see how much Apple is sensitive to exchange rate. So I'm going to use the Chinese win rate. So US, dollar. When, and again, I'm sorry, I have accent. So if I say the Chinese name of the currency, my apologies. Hopefully I'm not hurting anybody's feeling. So company G is going to be Apple in this case, and exchange rate. So we need to collect these 2 data from 2005, and then we're all done. All right, let's do that. Where are we going to go? We're going to go to Yahoo Finance. Yahoo Finance back. So thanks Yahoo Finance for making this available. Our data is monthly. Apply. So now I just want to mention here something very important to understand. Apply. This week, it's not academic research. This week is practitioners, like how Apple manage their business. So from the investor side, practitioners, like if there is investors, how they view Apple. If you smell there's a war between US and China, or you smell war between US and France or Germany, whatever, any country. Not a war, like the time of war, sending tanks and soldiers is over. War now is different than before. Tension, I should say, right? Then this exercise is very important. So, for example, I hear there is a lot of Biden China things. I think this is just a smoke. But if it's real, then Apple has to put back their lengthy arm and do a lot of protection or swaps. So let's go with that. Monthly data, fine, download. So Apple from 1980, I can see we have for Apple. So this is their data. I didn't need all this 95. I just, all right. So I need to 2005. Yes. What I'm doing here. Okay, good. I got everything I need about Apple. Let me explain something. Close and adjusted close. The close is the price of Apple closing. Adjusted close, it accounts for dividend, and Apple gives the dividend. So when you do the return for Apple, return, it's equal. I will use the adjusted close because dividend matters. It's not that big money here, but you have to do it right. divided by, so F3 minus F2 divided by F2, which is the price today, adjust the price for today, minus adjust the price for last month, divided by last month. Enter. Right. Double click. So now we have a January to this. Now, a lot of students, when they do the regression, have a problem. Yusuf, I have a problem. The problem they have is how to take this data, put it in another Excel, copy, Fama French, right-click here, put right-click on values. Because if you put equal this, look at the numbers, it doesn't make sense. You put values. Okay, so we got Apple data. There are 2 months here in Apple are not available in the other Fama and French, so we're going to delete them from the bottom. Make sure that in the bottom, again, people, I mean, I cannot do the regression, did not work. You have to make sure all of them are in the same line. It's not more data here, because if your X bigger than Y, the number of period doesn't work. So you have to do this. Now, different software does it for you, like Stata, but Excel doesn't. Now exchange rate, and we're done. We're done with our business. Exchange rate, dollar, American dollar to Chinese yen. So if you write here, there's many ways to do it. You do maybe dollar. So if you do dollar, that's a euro. China maybe. China currency, China currency. Should be a ticker. You can find it from here. What is the ticker for dollar yuan? So, not this, what I want. Here we go, USD, CNY. You won with the A here. Okay. No, with the A, good. Here we go. And historical data. I want, of course, monthly. Apply. I want next. Apply. And download. And it's here. So that's July, August. We are 2005, 1. Here is 2005, 1. So which one we're going to use? We use adjusted close again. So what is that number? 8.2. This means every American dollar equals 8.2 Chinese currency. Right click. Look to the Chinese currency is stronger now. So that's good for when the Chinese currency is stronger, it's bad for import, good for export. So when you have more export, you have more inflation in America. Why more export, more inflation? Because you sell more, and then you need to pay higher workers and oil and gas. So you have to, there's high demand. Again, values. Just let me do this insert just to show you how the currency was. They talk about currency manipulation. Select data, Excel. Let's get this from here. Since I mentioned 2018, let's see what happened end of 2018. So that's in 2018. You see this one here, students? That's a currency manipulation when it becomes to be when so the currency went up, went down. So there's some manipulation. Yeah, here went up again. When it goes up, that means China manipulate. When it goes down, so Trump said here there's manipulation, and then become to be flat, and then now we come to be like this after COVID. For the US, for us, we like a free market, no manipulation, no nothing. So basically, if you look at this figure, you can see that as a researcher, we like to have no manipulation in the currency. So that's what we like. We like a free market, open borders, and then the government can support. Like if the government want to support steel in America, just no tariffs, no nothing, just pay healthcare. The government say all the steel workers, their healthcare will be paid by the government. So that's one way to protect your worker, and that's a fair game. Now the other country can also protect their workers if they want, but then you have to make your priorities. Do you really want to have a steel and protect their healthcare, or you want to protect healthcare for single women, for example, or children, something like that? You have to make your choices, or this and that, and not to go to war, lower the army. A lot of ideas. It's our priorities, and in election we choose based on the priorities. Unfortunately, in our election we didn't choose priorities. We choose rather over our emotion and other things. All right, good, we're done. Now we cook the dinner, everything is here. I'm gonna copy that. I want to put everything in one Excel that you will see, and everything has to be values. Good, good. So I copy that here. Good, good. Everything we're done here. Basically, we're done with everything. Now, I just want to say something here. Here, the market return, that's a market risk premium. Insert command, risk premium, which is market return minus risk-free. This is risk-free. Why we need risk-free? To protect inflation. Risk-free. So we give you access from inflation. This is company J return. Company J return. And this is the exchange rate. Yuan dollar exchange rate. Good. Very good. We're done. Now, notice here the return is here, return in percentage. Here the return is not in percentage. So in order to make sense, you have to make apples with apples, oranges with oranges. So now what we want to do is we want to go back to this Word document, and we're going to see, we want to run this model, or this model actually, the extended one. RG minus RF equal alpha beta, RM minus R this and this. So now what we need to do, we're going to go back to this. Let me name this file, save as data exchange rates. Done. So we got that done. So now, again, I'm going to go back to the Word document. What is my left side, left-hand side? Left-hand side is RG minus RF, which is market company return minus RF after inflation. So you maybe ask me why you use the RF, which is a bond, not the inflation. Not a big deal, not a big difference. Usually the rates are very similar, but academically we use that. Now practitioners also use rates. Actually, practitioners use rate and academically we follow them. This time we follow them. So let me do my Y, insert. I'm gonna call this my Y, which is RJ minus RF. Okay, so we said equal to RJ, this company, minus parentheses. Keep in your mind, RF is in percentage. So divided by 100. Double click, I'm done. Next one, insert, is the first X, X1 I'm gonna call it, equal RM minus RF. Okay, so what is it? This is market minus RF, which is this, divided by 100, because this is a percentage. Now everything become to be apples with apples or oranges with oranges. That's X2, U1. That's X2, which is second variable. So what is that, Joseph, X2, X1? Here, let's go back to this model that we support. This is our left-hand side. This is our Y equal to, that's X1, RM minus RF, which is risk premium, plus exchange rate. So what we need the theta. That's our goal. So let's go here. So what I'm going to do, we did that probably before. So we're going to go home, sort of files, before files. You need to go to data. You should have something called data analysis. If you didn't have it, I don't know how they do it in Apple or Mac. So you go files, add ends. Okay. Files, options, add in. Excel adds in, you do go, and you click these two boxes, then you will get this one. If you uncheck these boxes, then this will go. Again, we need them. So we're going to do options, add ins, go, this, this, and this, and okay. I always have them in my Excel. I didn't drop them or add them. I always keep them. So I got everything I need. All right, so I'm going to go data analysis. I need regression. Here is regression. Okay. So what is our Y? Here is our Y. So our Y is this, amigo. Notice here, there are two observations here. You didn't have it. So what we're going to do here, first, we need to delete them. So cancel this, cancel. Cancel. We cannot have this more observation. We have to stop at 2021 October. All right, now we're going to do the regression again. Otherwise, we have a bias. Data, regression, okay. That's our Y. These two are X's. Now here you have to put labels. So let me do the X's first. Okay. Now you have to put labels. And then constant is 0. No, keep the constant non-zero. If it's 0 by itself will be. Okay, I'm done. So this is our sensitivity. Wow. Look at this one. So this is our theta. That's our theta. First of all, R square, this R square reflects the model fitness. Does this model, does Apple return nicely predicted by market return and exchange? The answer is yes. Look at this, 33%. Market fitness between 0, which is not fit, perfectly not fit, and 1, perfectly fit. Now we're 0.33, very good R square. So between 0 and 1, if it's 0, that means the model doesn't predict upward return. So So here, the return for Apple, keep in your mind, we're talking about return for Apple. The return for Apple increases if the exchange rate increases. So there is sensitivity. Is it statistically significant? Yes. Why? Because the T-stat is above 2. Again, let's go back to the exchange rate. There is something here in yellow. It says statistics has to be an absolute value above 2. So good. So that means we're good. We're very sensitive. So that's it. We're done. That's all what I want to do for today. Is if you want, go back to the Word document, we can see that that's our alpha J. And that will be our alpha J. Control copy, paste. Let's make it in a color here. We can go also say what is our beta, which reflect the riskiness or how much Apple can move with the market. And that's the riskiness. That means Apple is 120%, 1.2. If beta equal 1, that means Apple risk equal to the market risk. If it's 1.2 in this case, that means 20% higher than the market. So I'm going to give it a different color here. Probably give it that. And then theta, which is our key focus for this analysis, is this. So now we know that from this exercise, obviously, if you did this research, obviously, when you see that it is sensitive, then you have to watch Twitter when Trump was tweeting, and you have to watch the price of Apple. When Trump tweets, sell Apple. When Trump in that day busy with the Iran or other countries or with Democrat, then this is a day there is no tweet about China, then this is the day when you have to buy Apple. Seriously, I was looking to Twitter. Now I'm busy. I have other businesses going on in my life. I would not do it again. Back then I was free and I was learning what is that sensitivity. So it was fun for me. But so these stats above 2, perfect, more than perfect. So that means Apple is very sensitive to. So I'm going to call this inference, because now we know the case for Apple. Now we know that. So what Apple has, and no Apple sees that. Then what Apple have to do swaps. Now we're going to go back to the slides and see where we're standing. So we explain that's the outline, and then we talked about exchange rate sensitivity. See the Word document. I did that Excel file. We did that. Now main currencies that we have. The main currencies also in the Word document, but I can put it again here. Here are the main currencies that we have in the United States, that we care about businesses in the United States, and swap. Swap, again, we need to go to, I thought I have it here. No. All right. Okay. Swap, Investorpedia. A swap, here is the definition for a swap from Investorpedia, nicely done. And then if you want to link it, you just right-click. We're going to go back to the slides, right-click, hyperlink, and done. So now swap. So what is that swap? Why we care about it? So here's an Excel file that I will attach it to you. Here is an example for Apple in $1 billion revenue in China. That's a monthly data, $1 million in China. So they have a revenue 110 in one of the month, January, let's say, cost of revenue is 91 million. So what does that mean, cost of revenue? So when you sell phone, you have some suppliers, this and that in China. You have workers, Chinese Uber, if they have Uber, they have I'm sure they have a CEO in China, they have an office and the head of that office. So you have a lot of workers that you pay them Chinese currency, yuan in this case. So that we call it cost of revenue. I'm not talking about the profit here. I'm not talking about profit from China. I'm talking about revenue and cost of revenue in terms cash flow. How much cash flow in, cash flow out. In China. In this month, they have a cash flow cost of revenue 98. The revenue is 97. And that. So, not sure what happened. All right. In March, 107, 101, 97, 193. Swap. So how much? So what if the currency of China went down 10%, manipulation or something like that? Even 1% is big for them. It's a big loss. If you lose 1% China, 2% of just currency, you're not a good business. So you need to show something. What is a swap? Swap is an agreement between two parties to exchange sequences of cash flows for a set of period of time. Usually, at time the contract is initiated, at least one of these series of cash flow is determined. All right. All right. So how much currency exposure for Apple in this case equal to the revenue minus the cost of revenue? So in that month, they're going to have, for example, $90 million. In February, they have a -1. In March, they have a 6. And 26. So when you do swap, you didn't do swap for tomorrow, like if the currency go down tomorrow, because usually the currency doesn't evaluate a lot within a few days. What you do a swap for like December. If it's April now, if it's now, it's April now. So you worry about December when you have all of this cash flow coming together. You want to make sure that the value doesn't go down. So you need to do how much the swap or the currency under risk, excess revenue, that I need to protect, or in this case, to do swap. So I need to do something called in finance and economics, we call it forecast. Now, I did last week, probably we talked about price projection. That's one forecast. There's a Monte Carlo simulation. If you are a normal distribution or random walk, so you use some Monte Carlo simulation. I teach that in different classes maybe, but this is another forecast. Here is different forecast. It's for a swap. So Apple will ask, if this is the case of excess revenue I have that I need to swap it, or I have risk. So how much is going to be the excess return in December? And then what you do something called forecast, equal forecast. When you do forecast, there are multiple type of forecast. This forecast is ETS is exponential. This forecast seasonally adjusted, and then this and that. There's a linear. Now, our human being, our DNA, we like linear. If we see this and this, we make a trend. If one, we always like to make it a trend linear, but in fact, this is not true. Most of real world, like if you have two dots, you make an opinion about a person. He was bad here, he was bad there, so he's always bad. But in fact, it's not. People are bad and good. But our brain is linear. because when we have elementary school, 1, 2, 3, we didn't teach us 1, 5, 2, 17. We do it linear, 1, 2, 3, and then the brain established. And then we have a lot of education, hundreds of thousands of years, which is make people to be more linear. So when we educate our kids, linear, and linear is easy to educate. Anyway, so we're gonna use forecast, not linear, not exponential. We're gonna use this one, which is a default. It's also actually this one is more linear. So forecast. So forecast. So you're gonna say, okay, what is the revenue in December? Excess revenue for risk. Given this is the history about revenue, and this is the month that we worked on, 1, 2, 3, 4. Now I'm asking for 8 months flow, cash flow. Close, enter. That's it. $39.1 million will be in December. So you can do that. What's the revenue in December? That's a swap. How much you need to swap is $39 million. So now you have to make a contract that you give 39.1 million of Chinese currency, for example, for $1. But when? In December. So you take the exchange rate of today and you say, here is a swap. In December, you give me American dollar. So in December, you will give that person $39 million. And then if you want Chinese, so this is a yuan. So obviously you need to give them 39 million, in this case, 31 million yuan. And you ask me, give me the dollars in December for the exchange rate of today. So you protect that. So there's a fee for that. That's a swap. Let me do the forecast again, equal forecast. And you say, I want for December, given the revenue I have here in the past few months, given the period, the months I have here, close, done. You're going to do another forecast. And you're going to see what's going to be the cost of revenue in December, given the cost of revenue we have today for this period of months. And that will give you the revenue here for different months. Just for to check if this is equal 39. Yes, that minus that equal 39.1. So that's the formula is working. So your homework. Your homework is to do those. Let me make it in yellow. To replicate those, but for different numbers here. So I'm going to play with that. First, I'm going to delete them. So now you watch a video, you should replicate that. Let me play with the numbers here. Make it 94, 111, 151. Just here 103, 99. Okay, so I change enough here. So I wanted to create these 3 things. That's number 1 homework. Number 2, I want to inference. I choose a different company. Choose a different company just to change this. Just find a different company other than Apple and do what exchange rate you want. Yuan, you want euro. I can put the euro here if you want. Use any different currency, I don't care. US dollar, US. Here is US American dollar, or if you want a Japanese, depends what company you're analyzing here, historical data. All right. Monthly. Max. Apply. Good. So obviously the euro in 2003, but we're fine. We need January 2005. Control. No, did not help. Copy. Look here again, you have two observation here. You have to delete them before you do anything else. Choose any currency. If you want Euro, Chinese, Japanese, just do that. I'm fine with that. But you have to choose a different company. Or if you want to choose Apple, use American US dollar, Euro, dollar. If you want, or Canadian currency, depends. Like if you have a, you know what the Canadians, they have a lot of lumber they give us. If you have a lumber company, probably you have to do Canadian dollar, C dollar, we call it. And then so this, you have it, you're done. Here, you're done, you have that. If you want to choose one of these currencies, the Chinese or the European, then you're done. You didn't need to collect any data. Then all what you have to collect is just the company that you want to analyze. So put the numbers here, right click with values, and make sure in the bottom, you're done at October 2010, 2021, October. So no more observation. So if you choose a company here, and then make sure also, I see mistakes in your videos, is the student didn't know that you have to calculate that divided by 100 because this is a percentage. This is not a percentage. So apple and apple, oranges and oranges. So if you get a different company, put it here by itself, it will come here. And then you do the inference. I want to see this inference here. And then go to the swap. You create the swap for those. Forecast, 1, 2, 3 forecast you have to do. Now all of this, you didn't need it. In fact, you didn't need it if we have the crypto solution. I mean, we're done with that, but the problem is the banks and the politician didn't like that because it lowered their power as a politician and lower their profit as a bank. But if you have a peer-to-peer network, like for example, if you have a Bitcoin and somebody, if you're in a Bitcoin network or Ethereum network is even bigger than Bitcoin. If you're in Ethereum and Apple is in Ethereum in the network, and somebody from China buy Apple phone, and then China and Apple said, I'm going to charge you 0.1 crypto, Ethereum. Sorry, Ethereum is 4,000, 0.25 Ethereum. That's it. Then you pay. I pay my workers in Ethereum. My client in China buy with Ethereum. I didn't need a swap. I'm done. That's it. And there's no exchange. There is no swap. Swap is $1 trillion business. Do you think these people are going to give up quickly? No, it's not going to give up. They will go to crazy against it. So this is decentralized blockchain. America was before the credit card, Visa, MasterCard, PayPal, all of those was decentralized. You buy with a dollar. You have to have a lot of dollars, and you go to buy food or this, you have to pay dollars. There is no credit card. Credit card became to be recently in the 70s and maybe 80s. And then now we have it big time. So decentralized. Peer-to-peer give you decentralized because the buyer and the seller both are in the network. Then we have no problem. And the green miners, crypto solution. Crypto has a problem, is the miners. In order to the supply of coin, you have to be a miner to have an opportunity to win one of those. But your job is to verify transaction in a blockchain. For example, if I have a transaction between Joseph Bonaparte and you, then somebody has to verify that and add it to the blockchain. We call those are miners doing this job. In return, they get an opportunity to have a supply of coin. The problem is this miner is using electricity and pollution and things like that. So the solution is a green energy, which is solar panel and wind power and things like that. So that's what we have here. All of this really didn't need it. If we have a crypto, if everybody uses crypto, or everybody uses the American dollar or the Chinese, I don't care what country to lead us. I mean, the IMF should have their currency, the IMF, and then the currency will be done and will be for everybody, and that's it. But they don't want to do it. We talked about it. I'm done. Let me go summarize everything before we go. Today class was exchange rate and stock market performance. We have exchange rate. We have exchange rate sensitivity. We talked about main currencies and swap. Swap, you have to forecast your revenue or access excess revenue or the swap volume, which is revenue and cost of revenue minus cost of revenue. And then you based on that, you do the swap. The swap, for example, if you have a 39 million Chinese currency, yuan, and you want them in dollar, but you worry that the Chinese currency become to be weaker or stronger, and worry about that, you do a swap and you say, in December, I'm going to give you 39 million Chinese dollar yuan, and you give me dollars given the price of dollar of today. So you close the swap, then you didn't have a risk of currency. Well, you say, hey, Yosef, life is beautiful, then why you need crypto? Well, because you pay fees for the swap. You pay fees. All right. I'm done. Just again, this is the outline. You will find an Excel file. You have the data, you may use it, or what you have to change the company if you want to use it. And then you put the inference here. So that's going to be different. And then you do the swap, the new projection. I change the numbers here, do that. And then by doing that, basically, we covered this week of exchange rate and stock market performance. And that's it. If you might want to make me happy, really work on that and spend some time. And don't wait till Tuesday evening. And then email me, ask me extension. I know you're busy, and this week is a trap week after Thanksgiving. It's a very trap. People are tired and they have to catch up and coming back with work and things. I highly recommend that you start early. Thank you. I'm done.